Just imagine this. A machine sees a protest in one country, a shipping delay in another, okay, and a sudden drop in food imports and rise in fuel futures, and before the headlines even catch up, it already knows your groceries, fuels, rent, and the business cost is about to go up. That sounds like a science fiction, right? But what if I told you that this is already happening? Not in movie, not in 2035, right now as we are talking. The weirdest part is this. The people who understand how this system work are not waiting for the crisis to arrive to where they are. They are already moving money, changing strategies, and preparing for ripple effect before ordinary people even notice the first sign. And today, I want to show you something uncomfortable but very useful. Okay? AI is no longer just helping us predict the weather or writing emails. It is starting to predict the financial stress, supply shocks, political instability, and the money consequences that follows. And if you understand how that works, you can protect yourself very early. What's up, friends? In this video, I am going to walk you through something most people are not paying attention to yet. How artificial intelligence is being used to detect the early warning signs of a financial crisis. Not just in stock market stuffs. I am talking about the real life chain reaction that affects currency values, food prices, fuel costs, import bills, job security, business margins, and the cost of just trying to live normal. This is not a tech video for only tech people, okay? This is a money video, because once AI can spot instability earlier than humans can, the people who know how to read those signals will have a huge advantage over the other people. And the people who don't, they will think the crisis came out of nowhere. It usually does not. Okay? Let's start with the obvious question. Why are we talking about this now? Because the world has become too connected to ignore. A port strike in one region can delay shipments. A war can push up oil prices. A drought can reduce food supply. A currency shock in one major economy can hit importers in another country. A small policy change in a giant market can change a borrowing cost everywhere. In the old world, people waited for newspapers, central bank statements, or quarterly reports. In the new world, AI can scan satellite images, shipping data, news sentiments, commodity prices, social media trends, weather patterns, trade volumes, and even government language, how it is changing. Then it starts building a picture, not a perfect picture, but often a useful one. That means the market surprise is getting smaller for people who use the right tools, okay, and much bigger for those who do not. Here is the scary part. The same way your phone can predict your next text, okay, before you finish even typing it. AI systems are becoming better at predicting stress before it fully shows up in the economy. That is the game now, okay? How does AI predict trouble? Let's make this simple. AI does not predict the future the way the magician does, okay? It looks for patterns. It notices when shipping costs rise unusually fast. It notices the food imports, how the volume is falling. It notices how politicians start using harsher languages. It notices how factories slow down, how credit defaults is increasing, how currency volatility spikes, and it notices the how energy prices starts moving together in a weird ways. Okay, when enough of these signals align, AI can flag a possible crisis before most people even feel it. Think of it like this: a human driver sees the crash only when a car are already spinning. AI it sees the black ice, okay, the brake lights, the traffic slowdown, and the weather shifts before even the crash happens. That does not mean it always get it right, but it can warn you earlier than the average person. And in money, being early matters because if you know the fuel is likely to rise, you can plan the transport cost. Okay, if you know a currency is weakening, you can protect savings, and if you know imports will get expensive, you can stock up or shift sourcing. Okay, if you know the stress is building in the system, you can reduce the exposure before even panic hits. That is what this is really about. Not panic, but positioning. Okay, this is where things get interesting. Most people think AI only watches the headlines. That is not true. The smarter system are looking at things that feel boring until they suddenly become very important. For example, in shipping data, it is looking at are containers moving slower than usual, and in ports, it is looking at are goods stuck in one country or the region. Okay, in freight rates, it is looking at is it suddenly more expensive to move goods. In commodity prices, it is looking at are oil, maize, copper, fertilizers moving up strangely. In currency volatility, it is looking at how how a currency is losing strength against the dollar or yuan. Okay, and in such behaviors, it is looking at are people searching for recessions, shortages, or inflations more often. And in satellite imagery, it is looking at are factories operating normally. In news sentiments, AI is looking for our government is speaking more aggressively or defensively. And in bank lending data, it is looking at are businesses borrowing less because they are worried. Now, here is the non-obvious part. Sometimes the biggest signal, okay, the biggest signal is not the thing itself. It is the relationship between things. Example, if oil rises but the shipping stays stable, that may be manageable. But if oil rises, the shipping rises, the food imports slow, and the currency pressure grows at the same time. That is when the system is start to crack. That is the kind of pattern AI is increasingly uh, good at spotting. Okay, and that is why the finance people are paying attention because they know that the crises usually do not begin with one giant explosion. They begin with a several small warning lights blinking all at once. Okay, now let's do some practical examples. Imagine a country that depends heavily on an imported oil or imported food, machinery. Now imagine three things happen at once. Number one, a major shipping route becomes less reliable. Number two, oil prices rise. Number three, the local currency weakens against the dollar. At first, this look like a separate problem, but AI sees the chain reaction. it sees the shipping cost increase, and it sees the fuel become more expensive. It sees the importers are paying more, and it sees the wholesalers raise prices. It sees the retailers pass that cost to consumers, and it can also see the household spend more on essentials. Okay, more than that, it can also see a business reduce hiring and the economy slows. To most people, it feels like things just got expensive. To AI, this may look like an accelerating stress pattern. Now compare that to a person who notices only after the supermarket bills are already higher. That person is reacting late. The AI-enabled investor, trader, importer, or policymaker may already be adjusting. That is a power gap. Okay, a very huge power gap. And the power gap usually creates wealth gap. Okay, now let's talk history because this matters. People have to say this time is different. Sometimes it is, but history often rhymes. In the 1970s, the oil crisis shocked the world. The fuel cost rose, the transport cost rose, inflation it got worse, the businesses struggled, okay? The families felt the pressure in a daily life. It was not just about oil, it was about the chain reaction the oil caused, okay? Today, the chain reaction is even more complicated than before. Instead of only oil, we have a supply chain fragility, digital markets, algorithm trading, geopolitical tension, climate shocks, debt stress, and AI can either help stabilize things or exploit volatility faster than human can react. Back then, the crisis spread through physical fuel and industrial supplies. Now it can spread through data, expectation, and capital movement. That is why the comparison matters. The 1970s taught us that one key input can reshape the entire economy. Today, AI may be the thing that spots the new key input before everyone else does. So the question is not, will there be another shock? The question is, will you see it early enough to protect yourself? Okay? Now, who benefits from crisis prediction? Let's be honest. This technology does not benefit everyone equally. The biggest winners are usually hedge funds, the commodity traders, okay, and the multinational importers, central banks, large manufacturers, logistic companies, and the government with a strong data system. Why? Because they can act fast, they can move money, and they can hedge the risk, and they can change the sourcing, they can shift inventory, they can raise prices before others. Now here is the uncomfortable truth. When AI becomes better at forecasting trouble, the people with the money and the system gets better at escaping the trouble fast. That means the rest of the market often pays the bill. That is not fair, but it is real. This is why the story is not just AI is smart. The real story is AI may make the financial system more efficient for the people already inside it, while making life more expensive for those outside. That is a huge shift, and most people are not prepared for it. Let's talk truth, okay? And what this means for ordinary people, me and you. Now let's bring this down to earth. You may not trade commodities. You may not run a hedge fund, okay? You may not work in central banking. So why should you care? Because the financial crisis do not stay in finance. They show up in food prices, the transport costs, okay, the school fees, rents, phone prices, fuel prices, medicine prices, and business survival. If AI can predict an incoming cost spike earlier than people who understand the signals can prepare. Yeah. For example, a small business owner can reorder inventory before the prices rise. A family can protect savings from currency weakness. A freelancer can diversify income before clients cut spending. An importer can renegotiate contracts earlier. An investor can avoid buying assets at the wrong moment. The key idea is this: AI does not need to be perfect to be powerful. It only needs to be better than waiting blindly. And in money, waiting blindly is expensive thing. Okay? Think of it like driving at night. Before, people only knew the road was dangerous when they hit the pothole. Now, AI is like a car system that detects the pothole before the headlights fully hit it. But here is the catch. If you ignore the warning because the road looks fine, you will still hit the pothole. That is exactly how most people behave with these financial risks. They see calm, they assume safety, then the price shock lands. What the AI does is turn invisible danger into visible danger, and that changes behavior. Once enough people adjust early, the crisis itself can even move differently. Okay, that is one of most fascinating things about these predictive systems. They don't just observe reality, they can influence it. When people hear AI and finance together, they think stock charts, but what is AI actually seeing that humans miss? AI is often looking at weak signals that are individually meaningless but collectively powerful. One late shipment does not matter. One currency wobble does not matter. One weather disruption does not matter. But when those signals cluster, they can reveal an emerging pressure point before it becomes a headline. So, the real advantage is not a prediction in the magic sense. It is pattern recognition at a scale. The system don't need certainty, they need probability. And in finance, a strong probability signal is often enough to act on. Some people say AI crisis prediction will just make rich people richer. Is that actually true? I will say it can, but it can also help smaller players if they know what to watch. The problem is access. Okay? Large institutions can buy advanced models, but ordinary people can still follow the same broad signals: fuel, food, currency, shipping, rates, and policy language. Okay? So, the game is not to out AI the AI. The game is to use the warning signs matter. Okay? You don't need to predict everything. You need to prepare for most likely risks. Okay? If you could ask me, could AI ever cause a crisis by itself? Yes. If too many systems reacts to the same signals too quickly, you can get a feedback loop. For example, if algorithms all set at once, they can exaggerate a market drop. AI can reduce some risk, but it can also speed up the panic in people. Now we shift from analysis to action. What do smart people do when they see early warning signs? They don't panic, they prepare. Okay, they may hold a more balanced mix of assets, and they may keep emergency cash. They may avoid over leveraging. They may monitor a currency exposure. They may reduce dependence on a single client or market. Okay, they may they can do a lot of things. Watch policy and commodity signals closely. For ordinary people, this could mean building an emergency fund, diversifying income, avoid unnecessary debt, buying essentials in a disciplined way, and learning how inflation affects real buying power. Okay, one of the most underrated move is this: increase your financial response speed. Okay, friends, that means being able to notice trends and act before they fully hit your life. Speed matters. I say speed matters. Here is a surprising connection that most people miss. AI crisis prediction is not just about avoiding losses. It can also show where opportunity begins, because every crisis creates cheaper assets for some. It creates a new demand for alternatives. It creates a new local production opportunities and a new business models. For example, if imports gets more expensive, the local manufacturing becomes more attractive. If shipping gets slower, nearby suppliers become more valuable. If currency stress grows, businesses that earn in multiple currencies gain the edge. So, the same warning system that tells you danger is coming can also tell you here is where money may move next. Here is my bold but realistic prediction. In the next few years, the biggest financial advantage will not come from having the fastest reaction. It will come from having the best early warning system. The people who understand data, risk, and signal detection will make better decisions long before the average person even realizes the environment has already changed. That means AI won't just change investing, it will change survival. And that sounds dramatic, because it is. So here is the real takeaway. AI is not replacing human judgment. It is raising the cost of ignoring warning signs. The future belongs to people who can interpret the signals early, okay? Who can interpret the shipping delays, the currency moves, the commodity spikes, the policy shifts, okay, the behavior changes, and the small cracks that appear before the bigger break. If you understand that, you stop being surprised by financial chaos. And once you stop being surprised, you start making better moves. That is a real advantage, my friends. Okay? Not fear, not hype, just preparation. Okay? That is it for today. I am Dr. Adan Diba. See you in the next video.